Hello and welcome to my Knowledge Capsule series. Today I'm going to talk about why interest is tax deductible and therefore the cost of debt is lower as compared to cost of equity. I'll just share my screen quickly. So if you can look at my screen now, let's say I have an organization which is structured as under. You have equity, you have preference shares, and you have bonds. Now, let's say in INR crores, equity is 1,500 crores, preference shares is 1,000 crores, and bonds are 2,500 crores. Now, this is the capital structure assumed at the moment, which means the total capital employed by the organization is 5,000 crores. Assuming that the company is able to generate revenues with a 0.8 asset turnover ratio or capital employed to turnover ratio, it would mean that the company has generated revenues of 4,000 crores. Let's say that they are able to earn a margin of 60%. So which means that the COGS is 40%. And here we arrive at the gross profits, which is 2,400 crores. Assuming that the company also has operating expenditure, excluding depreciation, which is, let's say, 400 crores, 10% of revenues, which means that the EBITDA, earnings before interest, taxes, depreciation, and amortization, becomes 2,000 crores. Now we'll also assume that the company, the entire capital employed, 80% of this was invested in fixed assets. And 20% was in working capital, or yeah, maybe. So that is 1,000 crores. So the investment in fixed assets will lead to depreciation, wear and tear, consequently leading to depreciation costs. Assuming that they have a useful life of 25 years, the depreciation will be 160 crores, which means that our EBIT, which is the operating profit, is 1,840 crores. Now, assume that the preference shares carry a 12.5% dividend, whereas the bonds carry 8% interest. Now is the time to repay. Now is the time to repay. So once you reach EBIT is like a milestone. It completes or terminates the operating segment of the P&L and starts with the distribution segment of the P&L. So the next step is therefore reducing interest costs. They are the first ones to be paid So that is actually one of the reasons why the bondholders and anyone who's invested in debt capital of an organization feel secure, because they're the first ones to be paid once the operating surplus is ready. So interest in this case will be 2,500 crores of capital into 8%, which is 200 crores. So we reduce this interest and we arrive at profit before tax of 1840 minus 200, which is 1640 crores. Now, assuming that this company has a tax rate of 30%, we have a taxes of 492 crores, and therefore the PAT of 1148 crores. Now, this is where the net income is derived at. But in this case, we also have preference shares of 1,000 crores, attracting 12.5% dividend. So the company will have to pay preference dividend to the shareholders, which is 1,000 crores into 12.5%, which is 125 crores. Reduce that, you get your net income of 1023 crores. Now, this is where usually the profit and loss kind of culminates or terminates. After that, it's more about the extraordinary items or maybe the minority interest provisions based on, whenever there is consolidated financial statements being prepared. So there are two distinct segments, as I told you, the operating segment and the distribution segment of the P&L. Now, assume that you are the CFO of this organization. And one cost which you would definitely want to reduce is basically the cost of debt, interest. You would want to get rid. That may be a myth. I am not commenting on that now, but not that I am here to bust it. But that is one cost which you would like to get rid of in the P&L. बढ़िया बुद्धि बोलते हैं इसको, सबसे पहले ब्याज को हटाओ. So let's say that the CFO of this organization says that, okay, I will go for a capital structure which is without debt. So let's say I rearrange this capital structure, and now the capital structure doesn't have bonds, but the company still needs money. It can't run without this. So what they do is they issue more equity and there are no bonds. So there is no interest obligation therefore. So it's like a rebalancing of capital structure. You issue more equity shares to retire your bonds. And so now you are largely an equity-based organization to get rid of the interest of the finance costs. Now, if this is a rearrangement in the capital, is there going to be any difference whatsoever? Any difference whatsoever in the P&L? Well, in the operating segment of the P&L, there will not be any difference. The operating segment remains the same. Okay, so we will keep the revenue as the same. Cost of goods sold will be the same. Gross profit same. OPEX same. EBITDA same. Depreciation same. Up to EBIT, no change. Because for the operating segment, it's based on efforts. Paisa kahan se aaya doesn't matter. Paisa aaya, that's what is important. Interest. Now the distribution segment is where the difference will come in. Now we will not have interest cost because that's what the CFO envisaged and wanted to get rid of. So you have a higher profit, therefore higher taxes, therefore higher PAT. Now no change in your preference dividend also. And your net income is obviously higher. Now to a layman or to shareholders, this will appear as, wow, that's a wonderful thing that he has done. But mind you, if I want to calculate the return on equity in this case, the return on equity is 1163 divided by 4,000 crores of equity, which is about 29.08%. Because we have diluted the shareholding. More shares, the profits being divided amongst more shares, and therefore the EPS and return on equity will consequently go down. What about the ROE in the earlier case, where there was external borrowing or debt? It would have been 1023 divided by 1500, which is approximately 68.2%. So while in this case, the ROE is 29%, in the earlier case, the ROE was 68.2%. So that's the advantage that external borrowing can bring to you. One of the reasons is the tax deductibility. So please remember, in this case, if we were to move in this direction, okay, let's be conscious and cognizant about the direction that we are using. If we were to move in this direction, that means first we were here and now we have borrowed. We are incurring an extra interest cost. So the delta interest cost is nothing but 200 minus 0, which is 200 crores. Now, the thing is, there will be reduction in tax liability. Why? Because higher interest would reduce profit, lower the profit, lower the tax liability. So there is tax saving. So the tax saving is nothing but 60 crores, which means your effective cost of debt in absolute terms is 140 crores. Now, 140 crores on a base capital will 140 crores upon a base capital of 2,500 crores would mean 5.6% of debt, which means although the gross cost of debt is 8%, the effective cost of debt is 5.6%. Now, if I do, most of the textbooks will give you this formula, effective cost of debt is equal to I into 1 minus TR. So in this case, 8% into 1 minus 30%, which comes to the same number, 5.6%. Which means that even though the company is having a gross cost of debt of 8%, they have an effective cost of debt of 5.6%. So that's how the interest component of debt creates a tax shield, which is beneficial for the organization. Mind you, it doesn't mean that the company should go on taking debt and debt and debt. No, otherwise we will, run into a situation like where you will have to go helter shelter to reduce your debt later. So maybe a 2:1 could be a healthy debt equity ratio, debatable. In capital intensive industries, it could be higher. The service industries could be lower, but generally 2:1 is considered as an healthy debt equity ratio. Mind you, the best thing the CFO could do is to add debt to the point it creates optimal cost and thereafter stabilize and no more debt. But no debt is certainly not a very healthy scenario because of the benefits that accrue. And one of the benefits that I spoke about here is financial leverage, which magnifies the ROA of the shareholders. I hope you enjoyed this capsule. Thank you very much and look out for the next one. Bye-bye.